Okay, let's unpack this. We're staring down a number so immense it's almost hard to wrap your head around. $36 trillion.
36 trillion. Yeah.
In fact, as we're talking, it's quickly pushing towards $37 trillion.
Right.
This isn't some theoretical concept from a textbook. This is the real, live U.S. national debt. It's a figure that's dominating headlines, influencing financial reports, and frankly, sparking a whole lot of discussion.
And maybe some anxiety, too.
Definitely some concern. Immediately, the big questions jump out at you. How in the world did we accumulate this much debt? Why does this staggering number actually matter, not just in the abstract, but tangibly?
Yeah, what's the real-world impact?
Exactly. And for you, specifically someone who navigates the world of finance, who thinks about investments, who's planning for their economic future, why should you care about the national debt?
What does it mean for your money?
What potential impact could it have on your money, your portfolio, and the wider economic landscape you're investing in?
Well, what's absolutely fascinating about this isn't just the raw number itself, as dramatic as it is. It's the story behind it, right? The dynamic forces that have shaped its trajectory over centuries, the policy decisions, the economic cycles, the global events.
Yeah.
Our deep dive today is built upon a substantial stack of source material, everything from comprehensive reports by independent organizations like the Peterson Foundation.
Which are really detailed.
Very detailed. Insightful analyses from major financial institutions like U.S. Bank, coverage from respected news outlets like Al Jazeera and Politico, and crucially, the historical context provided directly from Treasury Direct itself.
That's exactly right. Our mission for this deep dive is to pull the most important nuggets of knowledge and insight from all these sources. We're going to take the raw data, the current numbers, the historical journey of U.S. debt.
Who holds it?
Who actually holds it, what's driving its rapid growth, and critically, the potential implications for both the broader economy and, yes, for your investments, and synthesize it into a clear, engaging picture. Hopefully.
Yeah, try to make sense of it all. And as we set the stage, the sources agree on a few foundational points. That headline number, $36 or $37 trillion total debt, is real and growing fast.
Astonishingly fast.
Al Jazeera points out it's been increasing by roughly $1 trillion every 3 months recently.
$1 trillion every 3 months.
Just think about the speed of that accumulation. We've also seen tangible reactions like recent credit rating downgrades, with Al Jazeera and Politico highlighting how concerns about the debt trajectory were explicitly cited by agencies like Moody's.
Right, that wasn't just random.
No, it was specific. And Politico and U.S. Bank underscore that the ongoing political debates in Washington about spending and taxes aren't just abstract arguments. The outcomes of those debates could significantly impact where this debt number goes next.
But here's a critical piece of perspective that comes through in multiple sources: Al Jazeera, U.S. Bank, the Peterson Foundation, and Stortell Capital Management. While that dollar amount is massive, the most revealing way to understand the debt's burden isn't the nominal figure.
It's not just the trillions.
It's its size relative to the economy's ability to generate wealth and pay it off. That's the debt to GDP ratio. We'll explore why that percentage figure is often more telling than the raw trillions.
Absolutely. That ratio is key. And, to truly understand where we are, we really need to see the long game. The U.S. having debt is not a new phenomenon. It's been a feature of the American story since its very beginning.
It's wild to think about, but Treasury Direct confirms it. The U.S. was essentially born with debt, accumulated from the Revolutionary War. By January 1st, 1791, that debt stood at $75.4 million.
Which was a lot back then.
A huge amount. Even before that, in 1783, it was $43 million. It wasn't some pristine, debt-free start.
Not at all. And this is where a figure like Alexander Hamilton enters the picture in a truly pivotal way. As the first Secretary of the Treasury, he wasn't just managing the debt, he was designing the financial architecture of a new nation.
A huge undertaking.
His view, which was pretty radical at the time, was that a national debt, if managed responsibly and if it is not excessive, could actually be a national blessing.
A blessing? That sounds counterintuitive.
Well, he saw it as essential to establishing good credit and credibility for the new federal government.
Yeah.
How do you prove you're trustworthy if you don't borrow and pay back?
Okay, that makes sense. He really was thinking long-term. Treasury Direct details his push for the federal government to assume the debts of the states, a very controversial move back then.
Hugely controversial.
And then issue federal bonds to consolidate it all. And it created some fascinating early opportunities for savvy investors.
Oh, yeah.
They mentioned this almost legendary example of a bond that might have traded for around $15 in 1786. But after Hamilton's plan was enacted and the federal government issued replacement bonds, that same underlying investment could be sold for $121.50 by 1792.
Wow. That's a massive return.
A massive return, fundamentally enabled by the government's approach to structuring and guaranteeing its debt. It showed the power of federal backing.
That early system, designed by Hamilton, really did help establish the government's creditworthiness. But the desire to pay down debt was also a strong impulse early on. Treasury Secretary Albert Gallatin, serving under Thomas Jefferson, made debt reduction a top priority.
And he had some success.
He did. He managed to get the national debt down to $45.2 million by 1811.
Which brings us to a truly unique historical moment mentioned by Treasury Direct, the only time the U.S. debt reached zero. Zero.
It actually happened, January 1835, under President Andrew Jackson.
He was famously distrustful of banks and centralized finance, wasn't he?
Very much so. He dismantled the second bank of the U.S., and remarkably, this period of, let's call it fiscal discipline, led to a surplus. In 1835, a $17.9 million surplus was actually more than the total government expenses for the entire year.
More than the expenses? That's incredible.
It was a brief but striding era of being debt-free. A historical anomaly, certainly.
Because it didn't last long, did it?
No. Debt quickly began to climb again, primarily driven by conflicts. The War of 1812 pushed debt from that $45.2 million mark up to $119.2 million.
And then the Civil War.
Oh, the Civil War caused an explosion in debt. It was just $65 million in 1860, but ballooned to $2.7 billion afterwards. Abraham Lincoln himself spoke of the terrible cost and national debt and taxation unprecedented.
The scale must have been shocking.
It forced a complete overhaul of federal finance, leading to foundational acts like the Legal Tender Act and the National Bank Act. They had to invent new ways to manage money on that scale.
And global conflicts continued to be massive drivers after that.
Absolutely. World War I saw the debt rise to around $22 billion. But World War II was on a scale we hadn't seen before, jumping from $51 billion in 1940 to a staggering $260 billion after the war.
Just astronomical numbers for the time.
Yeah, and Treasury Direct shares quotes from FDR's radio addresses, underscoring the total national mobilization required financially as well as otherwise. This era also saw the invention of savings bonds.
Right, getting everyday people involved.
Exactly, making it easy for average Americans to lend money to the government, which actually played a role in paying down nearly $50 billion of that war debt afterwards.
So after World War II, did things change?
Yeah, there was a significant shift in prevailing fiscal theory. The focus moved away from trying to balance the budget every single year towards using government spending and deficits strategically.
How so?
As tools to promote economic growth and stability, heavily influenced by the ideas of economist John Maynard Keynes.
Ah, Keynesian economics.
Exactly. So debt continued to grow, but for a period, especially when viewed relative to the growing economy or adjusted for inflation, its burden seemed manageable. That held largely true until the 1980s.
Ah, the 80s. The sources, particularly Treasury Direct, note this period as a real turning point for rapid debt growth.
Definitely. It more than tripled, going from $914 billion in 1980 to $3.3 trillion by 1990.
Why such a big jump?
This surge is often linked to increased military spending during the Cold War buildup, as well as new domestic policy initiatives like the war on drugs. There's a fascinating point in the Treasury Direct historical notes, referencing a USA Today article, that poses the idea that the Cold War was ultimately won less by armies and more by banks, suggesting Western powers effectively outspent the Eastern Bloc.
By borrowing.
By borrowing against their future capacity without sacrificing social spending, while the Soviet system was forced into austerity. It's an interesting take.
That period of rapid growth was followed by something different, though, right? In the 90s.
Yes, a relatively brief but notable period of fiscal surplus in the late 1990s under President Clinton. Both Treasury Direct and Al Jazeera mention this.
What drove that?
Mostly a booming economy, the dot-com boom was really taking off, combined with a stated commitment to fiscal discipline and deficit reduction. It actually represented the first balanced budget since 1969.
But that era proved temporary.
Very temporary. The sources are unanimous that rapid growth has been the story since 2001, accelerating significantly after the 2008 financial crisis.
Yeah, Stortal notes the debt has nearly quadrupled since just before the 2008 crisis. Quadrupled.
And the latest, most dramatic jump, the one bringing us to today's $37 trillion figures, is largely attributed to the massive stimulus measures enacted during the COVID-19 pandemic.
So much spending happens so fast then.
Huge amounts.
Yeah.
Understanding this history isn't just an academic exercise, though. It shows that the U.S. has always grappled with managing debt. But the scale and the speed of the increase we're seeing today, particularly in recent decades, are fundamentally different.
And largely unprecedented.
Largely unprecedented in modern history, yeah. This historical context helps explain the urgency and intensity of the current debates about fiscal policy and debt sustainability, and why it's demanding attention from economists, policymakers, and, yes, investors like you.
Okay, so that historical journey brings us right up to today. Now that we know how we got here, let's really try to get a handle on just how big this number is. Because $36 or $37 trillion is just abstractly huge. How do we make sense of it?
You're right, the raw number is overwhelming. It almost loses meaning. That's why, as the sources like Al Jazeera, U.S. Bank, and the Peterson Foundation reports show, it's crucial to break it down.
Okay.
They all give us figures around $36.2 trillion. We're approaching $37 trillion for the current total outstanding debt. And Al Jazeera underscores the speed again, noting it's been increasing by roughly $1 trillion every 3 months recently.
$1 trillion added every quarter. Just the sheer velocity is hard to grasp. And as you mentioned earlier, there's an important distinction that comes up repeatedly in the sources. The difference between the total or gross national debt and the debt held by the public. Why is that distinction important?
It's really key because the debt held by the public is the portion owed to outside investors, individuals, companies, foreign governments, pension funds, you name it.
Okay, the external IOUs.
Exactly. Treasury Direct's summary debt accounting gives us figures around $34 billion total outstanding recently, with $26.9 trillion of that held by the public.
So about $27 trillion held by the public.
Roughly. And $7.1 trillion held by government accounts. Al Jazeera's slightly more recent numbers are around $36.2 trillion total, with about $27.2 trillion held by the public and $7.36 trillion held by government accounts.
So the numbers shift slightly depending on the source and date, but the big picture is the same.
The exact figures fluctuate daily, but the relative proportions and the magnitude are consistent across sources. You're looking at roughly 3/4 held by the public, 1/4 held internally.
And that held by government accounts number, around $7 trillion, as explained by Al Jazeera and Treasury Direct, is essentially money the government owes itself, right?
That's right. Most notably, funds borrowed from the Social Security trust funds, but also other government pension or trust funds. So while it's part of the total debt number you hear, it's not subject to the same market dynamics as the debt owed to external parties.
Like bond yields and investor demand.
Exactly. Yeah. The debt held by the public, that roughly $27 trillion figure, is the one that responds directly to market forces and investor sentiment. That's the one that really interacts with the global financial system.
Precisely. And this brings us back to that crucial metric we mentioned in the intro, the debt to GDP ratio.
Yes.
Stortal, Al Jazeera, U.S. Bank, and the Peterson Foundation all highlight this as the most meaningful way to understand the debt scale, comparing the total debt burden to the size of the economy, which represents our capacity to generate the income potentially needed to service or repay that debt.
Think of it like comparing your mortgage amount not just to a giant abstract number, but to your annual income. A $500,000 mortgage feels very different if your annual income is $50,000 versus $500,000.
Excellent analogy. So what's the ratio now?
Well, Al Jazeera states the total debt, including intergovernmental, is around 122% of GDP currently.
Wow, over 100% of the entire economy's annual output.
Yeah. If we exclude the intragovernmental debt, the debt held by the public is closer to 95% of GDP. They also note the total debt to GDP ratio hit a pandemic peak of 133% in 2020.
And U.S. Bank and the Peterson Foundation focusing on that publicly held debt figure.
They project this figure will be around 100% of GDP by the end of 2025, right around that 1-to-1 mark.
100% of GDP for the publicly held debt alone. When you compare that to historical peaks, as the Peterson Foundation reports do, that number is approaching the levels we saw during World War II.
Right, which was an existential fight requiring total national mobilization, a completely different context.
And the projected trajectory from analyses like the Peterson Foundation's, based on CBO projections and EY analysis, that's where it gets really concerning for many people.
Yeah, that's the scary part. If current laws remain unchanged, the debt held by the public is projected to rise from around 100% of GDP in 2025 to 117% by 2035.
And the models show that climb continues aggressively after that.
Oh yeah. The EY analysis estimates it could reach 156% by 2055 and a truly eye-watering 206% of GDP by 2075.
200%. Double the size of the economy.
And the Peterson Foundation emphasizes that these projections don't even account for the potential impact of extending the 2017 tax cuts without finding ways to pay for them.
Which is a big political debate right now.
Exactly. Doing that would push these already high numbers even higher.
So yes, the dollar amount is a headline number, but the debt to GDP ratio is the crucial metric that puts it in economic context. And the projected path of that ratio is what sounds alarms for many, highlighting that this isn't just about today's number, but the potentially unsustainable trajectory we appear to be on under current policies.
And that trajectory is a direct result of running annual budget deficits, year after year.
Exactly. Stortl and Al Jazeera clearly explain that the total national debt increases year after year because the government consistently spends more money than it collects in taxes and other revenues. That annual shortfall is the budget deficit.
Simple math, really. Spending minus revenue equals deficit.
The rare instances when revenue exceeds spending result in a budget surplus, which Al Jazeera reminds us we last experienced briefly in the late 1990s.
Feels like a long time ago now.
Doesn't it? The current deficit is substantial. Stortl pegs it around 6% of GDP.
Which is quite high for a period without a major war or recession.
The Peterson Foundation reports it's projected to be $1.9 trillion in 2025. And Politico mentions the stated goal from Treasury Secretary Scott Bessent to work towards getting that deficit down to a more manageable 3% of GDP.
Historically, as Stortl points out, large deficits have been associated with periods of economic downturns or major wars events that cause revenues to fall and spending to surge.
Right, like the 2008 crisis or the pandemic.
Exactly.
Yeah.
Al Jazeera notes the deficit reached nearly 15% of GDP during the pandemic in 2020, a clear example of such a surge during a crisis.
But the concern now isn't just about crisis-driven deficits, it's about the persistence of large deficits even during periods of economic growth.
That's the structural issue. Stortl explains that tax revenues, while they increase with the economy, simply haven't kept pace with the long-term growth in government spending. Spending is structurally outpacing revenue.
And the sources zero in on the key drivers of this spending growth. What are they?
Well, Stortl points to both mandatory spending programs like Social Security and Medicare, which operate based on eligibility rules rather than annual appropriations.
Things that run on autopilot, basically.
Pretty much. And discretionary spending on areas like defense, education, and infrastructure, which Congress does decide on each year. However, the Peterson Foundation reports strongly emphasize that the long-term structural imbalance is overwhelmingly driven by the projected growth in entitlement programs and, increasingly, by the rising cost of interest payments on the national debt itself.
Those numbers from the Peterson Foundation reports are pretty stark on this point. Spending on major healthcare programs like Medicare and Medicaid is projected to grow from 5.8% of GDP in 2025 to 8.1% by 2055.
That's a huge jump.
And Social Security spending is projected to increase from 5.2% to 6.1% of GDP over the same period. These are significant increases in major programs that are politically very difficult to alter.
And then there are the net interest costs. This is the killer app, almost.
The interest on the debt.
Yeah. These are projected to jump from 3.2% of GDP in 2025 to 5.4% by 2055. As interest rates have risen, the cost of servicing that massive $36 trillion debt has soared, and this rising interest expense itself becomes a major and accelerating driver of future deficits.
It feeds on itself.
Exactly. U.S. Bank notes the average interest rate on the total interest-bearing debt has more than doubled since 2020 alone.
On the revenue side, Stortl gives us the breakdown. The vast majority comes from individual income taxes, corporate taxes, and social insurance taxes, like payroll taxes.
Right, the big three.
Tariffs, which are often in the news, are comparatively tiny, less than 2% of total revenue.
Yeah, they get headlines, but don't move the needle much on the deficit.
U.S. Bank and the Peterson Foundation reports highlight that a key factor influencing future deficits will be decisions around extending the 2017 tax cuts, extending them, without finding other sources of revenue or cutting spending would significantly increase deficits compared to current law projections.
That's a major policy choice looming. So understanding these drivers helps explain why addressing the debt is such a formidable political challenge. It requires grappling with highly popular, deeply ingrained entitlement programs and fundamental decisions about tax policy.
Big, tough choices.
It highlights that the deficits aren't just temporary issues. Their persistence and projected growth, especially from entitlements and rising interest, represent a structural feature of the current fiscal path. It's baked in right now.
The government is clearly spending more than it's taking in, leading to these persistent deficits that pile up as debt. But who exactly is providing the money? Who are the creditors holding this massive $36 trillion?
Right, where does the borrowing come from? The sources paint a clear picture of a diverse group of debt holders. Stordahl broadly categorizes them as investors, institutions, and other countries.
Okay.
Al Jazeera gives us a useful split. Roughly 3/4 of the total debt is held domestically within the United States,
So inside the U.S.?
and about 1/4 is held by foreign investors.
Let's look at the domestic side first, which Al Jazeera estimates is about $27.2 trillion. The largest portion of this, 42% of the total debt, or roughly $15.16 trillion, is held by U.S. private investors and entities.
Who does that include?
This is a really broad category. It includes things like U.S. savings bonds held by individuals, mutual funds, pension funds, insurance companies, and state and local governments.
So the chances are if you have a retirement account or own certain types of investments, you're a U.S. debt holder, perhaps without even realizing it.
Yeah, indirectly maybe.
Definitely. Al Jazeera even points out that Warren Buffett's company, Berkshire Hathaway, is reportedly the single largest non-government holder of U.S. Treasury bills, with a holding valued at a staggering $314 billion.
Wow, one company.
Then there are those intragovernmental holdings we discussed, the debt the government owes itself.
Right, the internal IOUs.
Al Jazeera says this makes up 20% of the total, about $7.36 trillion, while Treasury Direct lists $7.1 trillion under government accounts. Again, this is largely the Social Security trust funds and other government pension funds.
Okay, so that's private investors and government accounts. Who else domestically?
And finally, domestically, the Federal Reserve holds a significant chunk. Al Jazeera puts this at 13% of the total debt, roughly $4.63 trillion.
The Fed? But haven't they been changing their holdings?
Yes, that's important. As U.S. Bank and Al Jazeera mentioned, the Fed has been actively reducing its holdings since 2022 as part of its monetary policy strategy to tighten financial conditions by shrinking its balance sheet. Quantitative tightening, or QT.
Okay, so the Fed is actually selling off some of its treasuries.
Correct. Or letting them mature without reinvesting.
Okay, that covers the roughly 75% held inside the U.S. Now, the 25% held by foreign entities, which Al Jazeera values at around $9.05 trillion. Has that foreign share changed much over time?
It has increased dramatically over decades. Al Jazeera notes that foreign holdings have increased five-fold over the past 50 years, growing from just 5% of the total debt in 1970 to the 25% we see today.
Wow, from 5% to 25%. That's a big shift. And who are the biggest foreign creditors now?
According to Al Jazeera's latest figures, Japan is the largest single holder with $1.13 trillion.
Okay, Japan at number one.
The United Kingdom recently surpassed China to become the second largest, holding $779.3 billion. China is now the third largest at $765.4 billion.
Interesting that the UK overtook China.
Yeah, and it's noteworthy that Al Jazeera highlights China's holdings have actually declined to their lowest levels since 2009.
Why is that?
It's often seen as reflecting diversification efforts by China, maybe moving away from the dollar somewhat, and perhaps related to ongoing trade tensions with the U.S.
Any other surprising names on the list of foreign holders?
Well, Al Jazeera points out the Cayman Islands are a significant holder, with $455.3 billion.
Caymans, that sounds like.
Yeah, given its status as a tax haven, this holding is often seen as representing investments routed through the islands by investors elsewhere, rather than originating there. Canada is also a notable holder at $426.2 billion.
So why do these foreign countries and international investors buy such vast amounts of U.S. debt? What's the appeal? Why lend money to the U.S.?
Well, Al Jazeera explains that U.S. Treasuries are traditionally seen as one of the safest, most stable investments in the world. They're like the gold standard almost.
The risk-free asset, they call it.
Exactly. Foreign central banks and governments buy them primarily to hold as foreign currency reserves, a stable store of value. They also help manage exchange rates and provide reliable interest income. Stordahl emphasizes that despite the challenges and the rising debt, U.S. debt is still the global benchmark for a stable, low-risk asset.
That makes sense. But U.S. Bank highlights a potentially important shift happening now. with the Federal Reserve actively selling off some of its holdings, QT, and some foreign buyers, like China, reducing their exposure, who is stepping in to buy the massive volume of new debt being issued.
Because someone has to buy it.
Someone has to. U.S. Bank notes that individual investors and mutual funds are taking on a larger role as buyers. So maybe more people like you, indirectly.
And does that shift matter?
It could. U.S. Bank suggests this dynamic might contribute to upward pressure on interest rates for government borrowing. If the traditional big buyers are less active, you might need higher rates to attract these other buyers.
And Al Jazeera adds a geopolitical layer, noting the potential for major holders like Japan, and especially China, to use their substantial holdings of U.S. treasuries as a form of leverage in trade negotiations or other international discussions.
It's a financial tool with potential political implications, for sure. So, yes, you might be a U.S. debt holder yourself through your investments. Understanding who holds the debt reveals the deeply interconnected nature of the U.S. financial system with global markets and introduces those geopolitical angles. The changing dynamics of who is buying the debt are also a factor influencing the cost of that borrowing for the government.
Which is a huge deal when you're borrowing trillions.
Speaking of borrowing, how does the government actually go about getting this money? What are the nuts and bolts of this massive operation?
That's the responsibility of the U.S. Treasury Department, as detailed by Al Jazeera and Treasury Direct. When the government needs to borrow money, either to cover a deficit or just to refinance maturing debt.
Paying back old loans with new ones?
Exactly, rolling it over.
Well,
It does so by selling debt securities. These are essentially IOUs loans to the government with a promise to pay back the principal amount on a specific date, plus periodic interest payments. These securities are collectively known as treasuries.
and they come in different terms, right? Short, medium, and long.
Exactly. Al Jazeera identifies the main types. Treasury bills, or T-bills, are short-term, maturing in less than a year. Treasury notes, T-notes, are medium-term, typically maturing in 2 to 10 years. And Treasury bonds, T-bonds, are long-term, maturing in 20 or 30 years.
And the Treasury decides which ones to sell.
Yes, the mix of what the Treasury sells can influence borrowing costs and market dynamics. Sometimes they issue more short-term, sometimes more long-term.
And how does the Treasury sell them? Is it like just setting a price?
Treasury Direct provides some fascinating historical context here. In the past, they did sometimes set fixed prices and interest rates. But since 1971, they've primarily shifted to competitive auctions.
Auctions, like on eBay.
Sort of. But for trillions of dollars. This means the market, through bidding from investors, big banks, foreign governments, investment funds, ultimately sets the prices and thus the effective interest rates for the different types of treasuries.
So the market decides the borrowing cost.
Essentially, yes. This auction system ensures that each offering is sold efficiently at a market-determined price.
And the scale of these auctions is immense.
It truly is. Treasury Direct notes the Treasury conducts over 425 separate debt sales by auction every single year.
More than one a day on average.
Yeah. This constant activity isn't just to fund new deficits. A huge portion is dedicated to refinancing maturing debt, borrowing new money to pay back old debt. They note the Treasury funds about $22 trillion in debt operations annually, which includes all those rollovers.
$22 trillion in operations. That's mind-bending.
U.S. Bank gives recent estimates, highlighting the Treasury's anticipation of borrowing $815 billion in the first quarter of 2025 and another $123 billion in the second quarter, specifically by issuing new privately held marketable debt, meaning beyond what's needed for rollovers. So new borrowing on top of the refinancing.
And the Peterson Foundation, citing an IMF warning, points out that the Treasury has recently increased the proportion of those short-term T-bills it's issuing.
Right. This can be cheaper in the short run because short-term rates are sometimes lower, but it means they have to come back to the market more often to refinance, which carries its own risks.
Now, tied into this borrowing process is the concept of the debt ceiling. We hear about this all the time in the news.
Ah, yes, the debt ceiling drama. Al Jazeera defines this as a limit set by Congress on the total amount of money the federal government can borrow to pay existing legal obligations.
Existing obligations, that's key.
It's a political mechanism that requires Congress to authorize the government to continue paying for spending that Congress has already approved in the past through appropriations bills and entitlement laws.
So it's not about authorizing new spending, but enabling the borrowing needed to pay for spending that's already baked into law. It seems odd.
It's a uniquely American political construct, let's say. And as Al Jazeera and Treasury Direct both emphasize, this limit has been raised, suspended, or changed 78 times since 1960. 78 times.
It always gets raised
Yeah.
eventually.
Treasury Direct notes that the ceiling is routinely raised by new laws because the alternative, defaulting on obligations, failing to pay bondholders or Social Security recipients, would be catastrophic for the U.S. and global economy. They give the example of the Temporary Debt Limit Extension Act, suspending the limit for a period in 2015.
And U.S. Bank mentions Congress approving a $4 trillion increase to the limit in a recent reconciliation bill, showing the magnitude of these adjustments. Just huge numbers involved.
Managing the scale of borrowing and debt also involves a significant amount of technology. And Treasury Direct provides some interesting historical context on this evolution.
From paper to computers.
Exactly. From shifting away from physical paper certificates to electronic book entry accounting way back in 1968 to creating systems like Legacy Treasury Direct in 1986 for direct electronic purchases, leading up to the public launch of the online Treasury Direct portal in 2002.
So you could buy treasuries online.
Yes. They even mention early computers used for debt management, like the Great Brain Datamatic Model 1000 in the 1950s and 60s, through various mainframes over the decades. It highlights how technology has been absolutely essential to handling the increasing volume and complexity of tracking and managing the debt.
You couldn't do it with paper ledgers today.
Not a chance. Today, of course, it relies on state-of-the-art systems. This technological journey itself underscores the sheer scale of operations required just to keep track of and manage this debt. It's a massive plumbing system underneath the economy.
Okay, so we've charted the history, sized up the numbers, identified the drivers, met the creditors, and peeked under the hood of how the government borrows. Now for the question we flagged at the beginning, and the one likely most pressing for you, our listener. Does this national debt actually matter for you as an investor?
Right. The bottom line question. This is where we really need to synthesize the different perspectives found in the sources, because it's not a simple yes or no answer, and there are quite a few nuances. Stordahl Capital Management offers a crucial starting point here. They strongly advise distinguishing between your personal views as a citizen on government spending and taxation.
How you feel about it politically.
Exactly. And the objective impact of the debt on markets in your investment portfolio. They caution against letting personal political reactions drive investment decisions, suggesting it often leads to overreacting at the expense of long-term plans.
That separation is really important. Don't trade based on headlines alone. So let's look at the arguments presented in the sources about the potential negative impacts of this rising debt. What are the concerns investors should be aware of?
Okay. Several sources indicate that the sheer size and trajectory of the debt have already fueled concerns among investors and economists. U.S. Bank and Politico specifically point to the bond market as the arena where this concern is most likely to manifest and where investors can send signals.
The bond vigilantes, they used to call them.
Something like that. Politico describes investors already sending a gentle warning to Congress through the bond market, basically demanding higher interest rates.
And U.S. bank analysts note that if bond yields rise significantly due to debt concerns, it makes bonds a more attractive investment relative to stocks.
Right. Higher yield, same low-risk perception.
Which could potentially put downward pressure on the stock market. Stordahl also suggests that in the future, persistent rapid debt growth could make U.S. Treasuries less appealing compared to other potential investments globally. People might look elsewhere.
And in a more extreme scenario, Stordahl raises the possibility, while noting it's not imminent or likely today, this is a long-term risk that surging debt could eventually hamper the government's ability to roll over its debt smoothly.
Like finding enough buyers.
Yeah, potentially leading to skyrocketing interest rates, a weakening of the dollar's status as the global reserve currency, and the U.S. losing its prominent position in the global economy. It's presented as a long-term risk to be aware of, not a short-term forecast. The what-if scenario.
A more immediate concern highlighted by Politico and U.S. Bank is the increasing portion of tax dollars that must go towards simply paying interest on the debt.
Yeah, that's happening right now. As U.S. Bank notes, the average interest rate on the debt has more than doubled since 2020. The Peterson Foundation reports underline that rising interest rates cause higher debt service costs, creating a kind of vicious cycle that compounds fiscal pressures.
More debt means more interest, which means more borrowing.
Exactly. Stordahl even references a government projection showing interest payments alone potentially rising to $1.71 trillion annually within 10 years.
$1.7 trillion just on interest.
That's money that can't be spent on other priorities like infrastructure or defense or returned through lower taxes. It just goes to service past borrowing.
The Peterson Foundation reports also delve into the concept of crowding out, which we touched on earlier. Can you explain that again?
Sure. This is the idea that when the government needs to borrow such massive amounts of capital, its demand for that capital in financial markets competes with the private sector's demand for capital needed for productive investments, building factories, developing new technologies, expanding businesses.
So the government is soaking up the available money.
Essentially, yeah. This competition, driven by government borrowing, can lead to higher interest rates for everyone and reduces the amount of capital available for private investment, potentially slowing long-term economic growth. Less fuel for the private engine.
And as we'll explore further, analyses like the Peterson Foundation Yesterday Report project that this rising debt could lead to significant economic damage, impacting things like GDP, jobs, private investment, and wages.
Right. Politico mentions that the recent Moody's credit rating downgrade, citing debt concerns, focused minds in Washington and among investors.
It got people's attention.
It did. And that investors are clearly demanding higher returns to lend to the U.S. Treasury now. U.S. Bank agrees markets are aware, but perhaps not fully priced for the long-term implications yet.
Okay, those are the concerns and potential negative impacts. A pretty sobering list. But the sources also provide some compelling reasons for investors not to panic, or at least to understand why the predicted catastrophe hasn't materialized yet.
Right, it's not all doom and gloom in the analysis. Stordahl, importantly, points out that markets have generated strong returns over the past 2 economic cycles, despite steadily rising debt levels.
So rising debt hasn't equaled falling markets historically.
Not necessarily. This historical performance serves as a reminder that debt isn't the only factor driving market returns. Lots of other things matter too. Innovation, global growth, corporate profits.
They also note that historically, budget deficits often improve organically as the economy stabilizes and grows, even if they don't turn into surpluses. The denominator, GDP growth.
And a fundamental point, reiterated by Stordahl and Politico, is that U.S. debt securities are still considered the global standard for stable, low-risk assets. The safe harbor.
Even with all the debt.
Yes, Stordahl highlights that paradoxically, during times of global economic distress or uncertainty, investors and even other governments often rush into U.S. treasuries as a safe haven, viewing them as the most secure place to park capital.
That seems backwards.
It does. They cite the example of the 2011 credit downgrade. Instead of triggering a sell-off, it actually prompted investors to buy more treasuries because the U.S. still looked safer than alternatives like Europe at the time.
Wow.
Politico notes that while yields rose after a recent downgrade, they were high but not frightening yet, suggesting markets were absorbing it without panic.
Politico also quotes an expert noting there's a certain inertia in bond markets. A large percentage of holders are institutional investors, central banks, and funds, with mandates that prevent them from simply selling off large chunks of their treasury holdings easily.
They're locked in to some extent.
And here's a crucial, unique point mentioned in Politico. The U.S. government's financial situation is fundamentally different from a household or even most other countries because the U.S. issues its own currency.
The dollar.
And that currency, the U.S. dollar, serves as the world's primary global reserve asset. There is persistent global demand for the dollar, making it convenient for foreign entities to hold large amounts of dollar-denominated assets like U.S. debt.
So the U.S. can get away with more debt because everyone needs dollars anyway.
That's a big part of the argument. This unique status allows the U.S. to run higher deficits and accumulate more debt relative to its economy than other countries might be able to.
U.S. Bank quotes their expert, Bill Merz, saying that the government's debt is manageable today, emphasizing that the core issue isn't the current level itself, but the ability to sustain rising debt levels over the long term. It's about the trend line.
And perhaps most counterintuitively, Stordahl notes that some of the best times to invest over the past 2 decades have coincided with periods when the deficit was at its worst points of economic crisis, where the government was implementing significant stimulus.
Like after 2008 or during the pandemic.
Exactly. While this isn't an investment strategy in itself, they say, it supports the point about not letting fiscal policy concerns trigger an emotional detrimental reaction in your portfolio. Don't panic sell based on deficit numbers.
So it's a really complex picture for investors. You have these very real potential long-term headwinds and structural risks associated with rising debt.
The crowding out, the interest costs.
And we are seeing signals of concern in the bond market. But the unique role of the U.S. dollar, the safe haven status of treasuries, at least for now, and historical market behavior add significant layers of nuance and uncertainty about the immediate impact.
So the takeaway isn't simple.
No. The key takeaway, particularly from Stordahl, seems to be Separate the macro long-term risk from short-term market noise and emotional reactions, and stay focused on your long-term investment strategy. Understand the risks, but don't let them derail your plan.
Given these potential long-term headwinds, let's spend a bit more time on the specific projections of economic damage, particularly as detailed in the Peterson Foundation's report, which incorporates analysis from EY. This analysis attempts to quantify the macroeconomic impacts on the U.S. economy if the projected increase in federal debt held by the public under current law actually occurs.
Right, this gets into the what if this continues scenario. The report focuses specifically on that trajectory, where publicly held debt rises from around 100% of GDP in 2025 towards that 200% mark by 2075, assuming current policies continue.
And they use an economic model?
Yes, one that's designed to be similar to those used by official government scorekeepers, like the Congressional Budget Office, CBO, and the Treasury Department. They try to use standard tools.
And what's a key assumption they make?
A really key assumption in their benchmark scenario, which significantly influences the results, is that each percentage point increase in the debt-to-GDP ratio leads to an increase of 2 basis points. That's 15.02% in interest rates across the economy.
Okay, so higher debt means higher interest rates for everyone. Why?
They note this assumption is supported by academic literature, reflecting the idea that increased supply of government bonds requires higher rates to attract buyers, and also that government borrowing competes for capital with private borrowers, driving up the cost of capital for everyone. That crowding out effect again.
Does the report acknowledge that this is an assumption?
Oh, yes. They note that results are sensitive to this assumption and also model a scenario with only a 1 basis point increase, which shows smaller but still significant negative impacts. So they test the sensitivity.
So based on this model and its assumptions, what are the specific findings regarding potential economic damage relative to a hypothetical baseline where the debt-to-GDP ratio is stabilized at 100%? What does the economy look like?
Well, the projections paint a picture of a significantly smaller future economy than would otherwise be possible. They estimate a reduction in the size of the U.S. economy, measured by GDP, relative to that stabilized debt baseline.
How much smaller?
$340 billion smaller in 2035, $1.1 trillion smaller in 2055, and a substantial $1.8 trillion smaller in 2075. These figures are presented in constant 2026 dollars to provide a comparable measure over time. So real economic output lost.
And this reduction in overall economic output translates directly to potential impacts on individuals, right? Lower GDP means less income overall.
Exactly. The analysis projects a reduction in income per person relative to that stabilized debt baseline. $1,000 lower per person in 10 years by 2035, $3,240 lower in 30 years by 2055, and $5,210 lower in 50 years by 2075. These are meaningful amounts of lost potential income over a lifetime.
Wow. And what about jobs?
The report also projects a direct impact on the job market. Relative to the baseline, they estimate a reduction of 1.2 million jobs across the U.S. economy in 2035, growing to 2.7 million fewer jobs in 2055 and 3.6 million fewer jobs in 2075. Again, these figures are scaled to the size of the 2026 economy for comparison.
Fewer jobs mean reduced opportunity and potentially increased unemployment over the long term compared to a different fiscal path.
That's the implication. A primary mechanism driving these negative impacts is the reduction in private investment, which goes back to that crowding out effect we discussed.
Less money for businesses to invest.
Right. The report projects private investment will be reduced by 13.6% in 2035, 17.1% in 2055, and 21.6% in 2075 relative to the baseline. Less private investment means slower growth in productivity, innovation, and the capital stock that supports economic activity and job creation.
And all these factors, slower GDP growth, less investment, competition for capital, they must impact wages too?
They do. The analysis estimates a reduction in the average wage rate, the pay per hour relative to the baseline. 0.6% lower in 2035, 3.0% lower in 2055, and 5.3% lower in 2075.
Why lower wages?
This is linked to slower growth in labor productivity, because there's less investment per worker and higher capital costs for businesses squeezing profits. While it's the wage rate over a career, these percentage differences can add up to a significant impact on total lifetime earnings.
Now, the report does include important caveats, doesn't it? These are just projections.
Absolutely. These are projections based on a specific model and assumptions. They don't assume a sudden physical crisis or market panic, which could make things much worse. They also note that if interest rates are more sensitive to debt increases than assumed, the negative economic impacts could be even larger. And of course, economic models are simplifications of complex reality.
But despite the modeling limitation,
Despite those limitations, these projections from the EY analysis for the Peterson Foundation provide a powerful illustration of the so what behind the high debt numbers. They translate an abstract fiscal trajectory into concrete, quantifiable negative impacts on the future economy,
hitting GDP, jobs, investment.
and ultimately the potential income and earning power of individuals like you, the listener. It presents a clear argument that there are real economic consequences projected if the current debt path isn't altered. It's a warning sign.
So if analyses are projecting these kinds of long-term negative impacts, how are investors and markets actually signaling their awareness or concern right now? Are we seeing signs? What should we be watching for?
Politico touches on this directly, noting that some policymakers believe the bond market is ultimately the ultimate arbiter, the force that will eventually compel Congress to act on the debt if it becomes disruptive enough.
The market forces their hand.
That's the theory. And Politico argues that investors are indeed sending a warning, though perhaps still a gentle one at this point, through the bond market.
How so?
They described a new level of focus and concern among investors regarding the sheer volume of debt the Treasury needs to issue. Politico notes that investors are requiring a more attractive return, meaning higher interest rates or lower prices on bonds, to lend money to the U.S. Treasury.
Demanding more compensation for the perceived risk or supply.
Exactly. They point to the recent rise in yields for longer-term bonds, like the 20-year and 30-year Treasuries, which has pushed above 5% recently. While Politico characterizes these yields as high, they add, not frightening yet, suggesting it's not a full-blown panic signal, more like a murmur than a scream.
Politico also discusses what they call an unstable equilibrium in the markets. What does that mean?
It means investors have been hesitant to push yields dramatically higher, perhaps because they've been burned by previous policy shifts, or maybe they believe policymakers will eventually act before things get truly out of hand. However, a more painful signal,
Like what?
like a sharp, pronounced jump in yields, a failed auction where the Treasury struggles to sell its debt, or a significant credit event could potentially happen without much warning, disrupting this fragile equilibrium. Things could change fast.
U.S. bank analysts also connect the recent upturn in long-term yields partly to concerns about the deficit and future debt issuance.
Right, they reiterate how higher interest rates significantly increase the government's cost of servicing its existing debt, noting again that the average rate on total interest-bearing debt has more than doubled since 2020 to 3.28% by the end of 2024. That bites.
And U.S. Bank highlights the potential ripple effect on other markets, like stocks.
Yes. If Treasury yields continue to rise and become more attractive, it could lead investors to shift capital away from stocks and towards fixed income, potentially negatively impacting the stock market. The competition for capital again?
But they add a caveat.
Yes. They temper this by quoting their expert, saying that for now the debt is not a problem until the bond market deems it a problem, suggesting the market reaction, while visible, isn't yet at a crisis point. The market hasn't fully rendered its verdict yet.
The debate around the safe haven status of U.S. debt is relevant here too. Is it still the ultimate safe place?
It's a key question. While sources like Storedall and Politico argue it remains the default safe haven, particularly during global uncertainty, other perspectives suggest investors might be exploring alternatives.
Like what?
A source cited as U.S. debt crisis points to the significant increase in central bank gold buying globally in 2024 at 1,180 tons as potentially indicative of a move towards alternative safe havens, maybe diversifying away from the dollar.
And the dollar's value itself.
They also note a decline in the dollar index, which could be partially related to concerns about U.S. fiscal health, though many factors affect exchange rates.
Ultimately, though, Storedall brings it back to the long-term investor's perspective.
Yes, they reiterate that despite periods of high deficits and rising debt over the past century, markets have historically generated strong returns. Their core advice remains consistent. Avoid making drastic, emotional changes to your portfolio based solely on fiscal policy headlines.
Stay the course, basically.
Stay focused on your long-term investment objectives and asset allocation. U.S. Bank's expert Bill Merz adds that while the debt is manageable today, the concern lies in the ability to sustain these rising levels over time. And crucially, the sooner policymakers address the structural drivers of the debt, the less painful the necessary adjustments are likely to be. Kicking the can makes the problem bigger.
So this section directly addresses the investment angle. It shows that while markets are aware of the debt issue and are starting to signal concerns through yields, The reaction is complex and influenced by many factors, including the unique role of U.S. debt globally.
Exactly. The takeaway for you is not necessarily to panic, but to be informed about the potential long-term headwinds and market signals while grounding your investment decisions in your own long-term plan rather than short-term fiscal anxiety. Be aware, not afraid.
Let's try and bring all these threads together then. We've taken a deep dive into the U.S. national debt, understanding its truly massive size, now pushing towards $37 trillion, and the alarming speed of its recent growth.
We've traced its long history from the nation's birth, through periods shaped by war and evolving fiscal philosophy, right up to the rapid acceleration seen in the last 2 decades particularly.
We've broken down the numbers, clarifying the distinction between total debt and debt held by the public, and emphasizing why the debt-to-GDP ratio is the critical metric.
The context matters.
Showing us approaching historical highs not seen since WWII and on a projected path to significantly exceed them under current policy.
We've identified the core drivers of this debt accumulation. Persistent annual budget deficits, fueled structurally by the projected growth in entitlement programs like Social Security and Medicare, and increasingly by the rapidly rising cost of interest payments on the debt itself. That feedback loop.
We've explored who holds the debt, a complex mix of domestic investors like yourself, likely through your investments, government trust funds, the Federal Reserve, and a significant portion held by foreign entities like Japan, the UK, and China, each with their own reasons for holding treasuries.
We've touched on the mechanics of how the government borrows by auctioning different types of Treasury securities, a massive technologically advanced operation, and the political layer added by the often dramatic debt ceiling debates.
And we've wrestled with the crucial question of whether all this debt truly matters for you as an investor. We've weighed the arguments about potential negative impacts from increased interest rates and crowding out private investment,
to the projections of significant long-term economic damage, detailed in analyses like the Peterson Foundation EY report, which forecasts reductions in future GDP, jobs, investment, and wages if the current trajectory holds. Real potential costs.
But we've also considered the counterpoints. The historical resilience of markets despite rising debt, the unique, albeit potentially evolving, safe haven status of U.S. debt.
Still the benchmark for now.
The practical inertia in bond markets, and the fundamental advantage the U.S. has in issuing the world's primary reserve currency.
For you, the listener, this deep dive highlights why the national debt isn't just a distant political issue in Washington. It's something that shapes the economic environment you're investing in.
Yeah, it affects everything eventually.
It potentially influences the long-term growth of the economy, the availability of job opportunities, and even the future purchasing power of your income and investments as more government resources are consumed by interest payments. The outcome of this ongoing fiscal challenge could influence the financial landscape for decades to come.
So as you process all of this information, the projected significant negative long-term economic impacts if the debt continues its current path, contrasted with the historical evidence that markets haven't always reacted negatively, even during moments like credit downgrades.
And the unique safe haven status the U.S. dollar and treasuries currently hold.
Here's a final thought to consider. How might that unique safe haven status truly evolve in the face of this unprecedented volume and trajectory of debt?
That's the multi-trillion-dollar question, isn't it?
Could there be a threshold, a point where the sheer scale or speed of the debt accumulation fundamentally challenges the dollar's role or the global attractiveness of treasuries in a way we haven't witnessed before?
When does the market finally say enough?
What specific signs, beyond the gentle warnings we see today, might truly signal that foundational shift? And if it were to happen, what cascading effects could that have on global markets and ultimately on your investments?
It's a complex question with no easy answer, but one definitely worth keeping in mind as you watch the headlines and manage your own portfolio in the years ahead. Something to think about.